What up, young slumlords and ladies? This is Jake Lapp, and welcome to the Young Slumlords podcast, where me and Caleb Henshaw talk our shiz and hopefully help spark the idea for finding your financial independence in this paycheck-to-paycheck world. Welcome back. What's going on, everybody? Super fortunate. Again, this week we have Dylan. He works actually with a previous guest, Todd, and he's a part of Todd's team, and he's a mortgage officer. And he's worked with both me and Caleb directly through our transactions and has been just a great resource for the both of us. You know, I'm always sending him late night emails and random questions like, what do you think about this? Would this work? Would this work? Like, I know I'm probably a trouble client, but it goes really appreciated. And he's also investing, and we wanted to kind of talk about some of that stuff. It's going to be a really cool episode. So, you know, with that, Dylan, welcome.
Thank you.
Yeah,
great to be here.
We're glad to have you, man.
We're actually coming at you live right now from the duplex you helped me settle on.
Oh, very cool.
Yeah.
So,
very cool.
Yeah, we wanted to kind of just start right off and ask you, you know, how did you get started in this field? How did you get started in real estate? And just kind of guide us through to where you're at now.
Sure. My transition into mortgages, into real estate, I had been in a career. I graduated college. I was working at a doctor's office. That's initially what I had thought I wanted to do with my life, was to be a doctor.
So you went to med school? Is that what you went to college for?
I went to my undergrad is in biochemistry. And then I was studying for dental school, actually. And I just kind of lost steam and focus and realized it's not really what I wanted to do. So I was kind of lost, just looking for what I could do or what I wanted to do. And I'd actually started working for Chris Hennessy, just kind of helping him out around the office, doing assistant type stuff. The real estate industry, although it's very intriguing, that didn't excite me as much as financing did. And so I had kind of got introduced to Todd. He was looking for somebody very entry level to help him out with just scheduling appointments. At that time, things weren't as electronic as they are now. So we were still collecting paper copies of everything. And, you know, as simple as it sounds, my job was like removing staples from people's tax returns and scanning them in. But while you're around this industry, you get to pick up things. And that's kind of what's led me to be what I do today. Now I'm a loan officer myself, and I help clients buy homes. And as you mentioned, I bought my first house last year, and it took a while to save and get my finances right and obviously wait for the right property to come along. I've been looking at single families and duplexes, and for me, investing or becoming a real estate investor, if you will, had always intrigued me. But what I had realized is the duplex side or a triplex or a 4-unit would have been ideal. I'm a single guy. I didn't need a lot of space. So buying a duplex and living in the 1 unit, building, you know, rental income on my tax return, stuff like that, just made a lot of sense to me. And that's kind of how I ended up with the property that I ended up with. You know, it's had its ups and downs, buying a house, that kind of stuff with repairs, things that you didn't expect that come up afterwards. But it's working out really well. And I'm happy that I did what I did, because it allowed me to put less money down when I bought the house. And then at some point it'll be a full-blown rental, just paying for itself and making a little extra on top of it.
Nice. So how did that process go then? The house, when you picked it out, you mentioned you had to do some work. Was it kind of rough? Was it like close to turnkey? Like, was it just remodeling, or was that like a kind of like gutting the house? How did that look?
Yeah, not quite that bad. From the photos and the home inspection, everything looked great. It was a lot of, they were unforeseen things that came up. I kept having water flood my basement. And it took a long time to figure out what it was, and it ended up being pretty expensive in the long run. But yeah, the worst was Christmas morning. I'm all excited to go to my family's house, open up presents, watch my nieces and nephews, and I just decided to check on the basement because I've been getting water in there, and there was like 3 feet of water throughout the whole basement. Heaters underwater, hot water heaters underwater.
No.
And like, there's nobody you can call. It's Christmas morning. It's like 9 a.m. It was a nightmare.
When you said that you had water in the basement, I'm picturing, everyone's got like the wet basement, like the corners are wet, but 3 feet of water. Holy crap.
It was so much water. I still don't know how that much water got down there in that short a period of time, because the day before there was no water in there.
Oh my word.
I was going to say my solution to water in the basement is just putting skids down, because I got a couple inches, but I'm not going to dig all that out.
Yeah. Yep.
So what was that? Was that like like part of the main that was cracked, or like one of the pipes that were coming in from the street that was flooding that much?
Yeah, two things. One was the pipe that there is a specific term for it. I just can't think of it. Whatever connects your main sewer from the house to the street itself was
the
clogged.
lateral. Yeah.
The lateral. Thank you. Yeah, was clogged and not allowing water to drain out. And the gutters, it was very common, especially in the borough in town, that they used to, in like the 50s. The house that I bought is very old. It was built in like 1901. Still has a slate roof, like the original slate roof. Anyway, when they put indoor plumbing and all that, they actually wanted your rainwater that you would collect from your gutters to go into the sewer, because back then there wasn't as many houses, and it would help keep the sewers moving and flush things out. Then as more houses came, they couldn't handle all the additional water, so they made everybody disconnected. Well, I assumed that mine was disconnected, and it was not. And so because the lateral was clogged, the water that was coming down the rain spouts, instead of going out the lateral and into the sewer, it was just coming into my basement.
Wow. That's crazy. So can you run us kind of through this deal? Like, where was it? How much were they asking? All that good stuff.
Yeah, I got really lucky in the sense that the house came on the market and it was listed as a single family home, but it was actually a duplex.
Yep.
I think that they just didn't market it the right way, because I think I would have gotten into a bidding war with actual investors who would have been buying that house in cash.
Absolutely.
But they never saw that it was even available. So I went to see it like real early on, first couple days that it was on the market, and just made them, I didn't do anything crazy like what you'll see now with people doing 10%, 15% over. I just gave them full ask, kind of explained to the listing agent that, hey, I'm a mortgage loan officer. Like, I can assure you that you're not going to have any mortgage issues with this. It's basically as good as cash.
Yeah.
And I was able to get it. It wasn't anything.
Yeah. What did they have it listed at?
It was $325.
Okay. And what were the rents that you were expecting?
So the bottom unit, the way the duplexes worked out is it's top and bottom. You come in the front door. It was a single family home, obviously, at one point. Yep. And the first floor, basically the whole first floor, is a one bedroom apartment. And then the other unit is the second and third floors, and that has 4 bedrooms. One of the bedrooms you have to walk through to get to the other one. But, if you had kids, you could call it 4 bedrooms. Actually, the people that I bought the house from were also owner occupants. So they lived there plus rented the one unit out. And they had 5 kids, and they were all in this place. And I don't know how they made it work, but there was enough space apparently for all that. Yeah.
So I'm guessing that you lived in the 1 bedroom, or you're living in the 1 bedroom, or are you living in the bigger one?
I'm unfortunately living in the bigger one.
Oh,
the 1 bedroom is what I wanted. And I had actually offered my tenant if she wanted to switch. She came with the property. She wanted to stay, and she's been very good, pays on time, super clean. But she has trouble with her knees, so she can't do stairs.
Yep.
So she needed like that first floor space. But obviously, I would have loved to have been in a smaller unit, because I don't need the space, and rented out the bigger unit for more. But we'll see if she ever moved out. That's 100% what I would do.
Yeah,
is flip flop. But
now you've got your mortgage. The mortgages. What's how much is it offsetting? Like, how much are you paying now for your mortgage?
So I basically am about 700, because she pays 1,000.
Mm-hmm.
My mortgage payment's like 1,750. Yep. So basically, I pay 750 of that.
Nice.
Fortunate for me, the utilities are split. So as the landlord, I do have to pay for water and sewer, because they won't split that out.
Yep.
But she pays her own electric, all that, and gas. And there are 2 heaters. So
nice.
It'll be an interesting thing to have to replace at some point, because there'll be 2 of them. But but on a monthly basis,
I was gonna
it's
say
something
put
cheap.
some electric baseboard heaters in
That-
when
or
they
that-
That's
or
exactly what I have. So my layout in the duplex that I'm in is identical to what you're saying.
Okay.
But and same with Caleb's. If we both kind of have the same duplex, but
Yep.
we're both in the one bedroom and we're renting out the top. But for yours are both baseboard, electric baseboard. Mine, it was all off of one heater, and the guy like just closed the ducts off to the one bedroom, put electric baseboard in. So now there's one heater heating the
Just for the second.
yeah.
Okay.
So I mean it's definitely cost effective, and if the tenant pays their own electricity, it is really nice. And it's funny that you said that how you found it, like it was listed as a single family. Like that was the same situation with the triplex that I got in Quakertown. Like it was listed as a single family for 6 months.
Yeah.
So like when they realized and made the switch, it was like within minutes I was over there and made an offer and did all that good stuff. So, but it's just funny that very similar stuff.
I did want to ask you about like inheriting that tenant, like going through like your thought process there, because I had like pretty much the exact same scenario that you were in. I had a tenant in the unit I wanted to live in,
But Caleb just kicked him out.
well, I didn't just kick him out, but I stopped here one day on my lunch while I wasn't living here when I first bought it. So I just, talked to him on the front porch and just said, hey, these are the numbers. I ran through everything with him, and he's like, I understand. And then I gave him 2 months to find a new place.
Find some place.
Yeah, and then he ended up finding a place actually in 1 month, so I got some time back to work on it. But I was curious what like your thought process was for that and how you planned on approaching it and just how it turned out.
With talking to the tenant, like I waited till I moved in. Last year, as I'm sure you guys know, the mortgage business was insane. I mean, I think back, I'm like, I don't even know how I was able to take that on, because I was working from like 6, 7 in the morning till like 1 in the morning for like 6 days a week. It was just crazy trying to keep up with everybody trying to refi and everything. So I knew that it was the right time, and I knew that I wanted to buy the house, and I just tried my best to put as much effort into it as I could. But that I just waited till I lived there. And then one day I just met her, I happened to bump into her, and I just struck up the conversation and asked her. And then she explained to me that didn't really work for her. So
yeah, I could see that being challenging. Like we were looking at a place near Jake's duplex in Souderton that had an older lady who'd been living there 30 years. And I'm like, I can't imagine like trying to have that conversation. Just be like, yeah, I need this unit so I could save $200-300 a month. It's like,
and that weighed through my mind too, right?
Yeah.
Like she told me she wants to be here for a long time. She had been there for a long time. And I'm like, well, I don't plan on being here for a long time. So I'm like, does it even make sense to get rid of this tenant who wants to stay, who keeps the place nice, who pays on time? I'm almost like, I'll just suck it up for the couple months that I'll live there, or a year. And that way, when I do move out, I know that there's at least one of those people that's like long term and they're going to pay. I weighed that option too.
So your monthly payment is $1,750. When you move out, what are you expecting to rent your current unit for?
I'm hoping, I might be crazy, and we'll see what the rent is at the time, but like I was hoping for like $1,800, but I don't know if that's possible. And I think before I moved out, my place it's nice, but it's like dated. So I think I'm going to have to, if I wanted to get like super top dollar, there's definitely going to be some things that I got to do first to make it get that. But worst case, I mean, if I had to move out in a pinch for, I don't know what reason would cause me to do that, but I figure there's no way I could rent it less than, or I'd have any problems for like $1,300-1,400.
Yep.
And then at that point, I'm pretty cash positive.
Yeah.
What area is that in?
It's right in Souderton.
Oh, okay. Yeah.
It's on West Broad Street.
Nice.
Oh, we're literally neighbors.
Yeah,
I'm
we're pretty close.
Yeah, I'm on Penn. No, that's crazy. So what is your thought then going forward? Are you like, whenever it's convenient, or I find the next good deal, or like, are you trying to structure it every year I'm doing this? Like, what's kind of your thought process there?
I've considered like all that stuff. I'm not sure. And then I'm no longer, I mean, I'm not married, but I do have a special someone in my life now, and that's going to play a factor in it too.
Absolutely.
She's kind of made it because I proposed that, like, hey, why don't you move in here, and then we can live here super cheap, and then we'll go buy something. And she made it pretty clear that she had no interest in doing
living
that.
with tenants and stuff.
Yeah,
Yeah, that's
so
tough. It's a tough sale, especially, when you're used to not. So it's
Right.
easier when it's like coming from parents' house to like, okay, this is the next step. But
Yeah.
like, yeah, I can definitely see that being a hard sale. It was a hard sale even with it being the next step. Like I've said before, like when I got the triplex, it was like, hey, Caleb, we're moving to Quakertown. Like we're moving to this apartment. And
Yeah.
but yeah, so it's funny that you say that. But so would you consider, doing more just like strictly investment properties, like with the amount of business you guys have been doing, like I'm sure you're doing all right and ready to, you see how your money's working for you now through real estate, and it's like, what's your thoughts then? Next step, or
that is my goal. Like,
Yeah.
So the next house might be a single family. Like if things keep going in my personal life, like that might just have to happen.
yeah, absolutely.
But yeah, I've always looked at your retirement or your income. You can't ever really 100% plan for the future. So even though real estate's been very good to me, like there could be some point in the future where it's not. And when you're 100% commission, like having a 0 month is like a real fear. Things add up quickly.
Absolutely.
So what I love about real estate and rental income is it's always going to be that supplemental source of income where, yes, you have to put money aside for repairs, things like that. But in a pinch, if I needed, a couple $100 a month to help supplement some other things, it would be there. And so my goal is to buy more. And obviously the bigger the properties, the more rental income there is, although there's more expenses. But yeah, I would love to be able to have like a couple $1,000 would be amazing coming in each month, like passive income.
Yep.
Where like you're putting up a big amount of money on the down payment, but it's essentially going to equity. It's not like it's going away.
Right.
But it's no different than putting that money in the stock market. It's less risky, but it's no different. You still don't have as easy access to it
Right.
when you're putting it in real estate. So I would love to do that. I haven't really talked with anybody, and you guys might with your connections and people you spoke with. Like I feel like at some point you're going to get to a certain point where like it's got to be overwhelming to keep track of everybody's rents, security deposits. Like how do you manage that? I don't know if you guys have had any horror stories or.
Yeah, I mean, I have 4 tenants. Caleb has
Yeah.
1. Like, I guess you can consider it 5 because I'm renting a shed out now to another person, so they gave me whatever.
Hopefully he doesn't call you with
Right.
with problems.
I
Right?
know.
The basement flooded in my shed.
Yeah.
Yeah.
So, so with all that stuff, like it's so not complicated. I do everything through Venmo. Everyone pays me through Venmo, so it's like I'm expecting 5 payments every month. If most of the people pay me early, so it's like the day of, or the night of the first. I'll go through, and if someone didn't pay, I'll just be like, I'll normally wait till the next day, and then I haven't had to like text anyone for it. And then it's the same thing with security deposits and stuff, keeping track of that. Like I'm big on like, and I think this is what a lot of mortgages call for, but like 6 months in reserves per property, like so that you have those reserves per property. And like I think a lot of people in the rental space like can lose track of that. So it's like per unit, like this duplex, if the roof goes bad, if the water heater explodes, if the heater, if everything goes wrong in the same day, I have the money to cover it in my reserves. And like I treat each property that way, so like my 0 has just increased. And so like my security deposits with that having, it's just all in that bucket.
In the pool.
Right.
We had a episode 14, a guest on who was self-managing 9 single families, and
Wow.
he just had spreadsheets on spreadsheets for everything, and like he was in a good position where all of his houses were identical. It was in the same development, so he had just one sheet of supplies to buy when he would know everything about the house, and like you write down what type of light bulb he would have in this specific socket and stuff like that. So like you can go all in on documentation. I'm a big spreadsheet guy myself, so I got lots of them just with everything written down, all the information, keep the leases digital, that kind of stuff. So that way we need to find it, you can go back and get it. I think just writing things down is just the easiest and most important thing to do, because honestly, like you don't have that much stuff to do, like as a landlord, you know what I mean?
Yeah.
Like it's just like a few little pieces of information that are really important when you need them, but it's not very often you need them.
Yeah.
Sure.
I'm definitely on the more lax side. Like I'm not as like spreadsheet oriented and doing all that stuff. But like
shoebox full of receipts or something.
Oh, I did get better with my expenses. That I actually have been doing the Excel sheet for the expenses, and my tax lady thanked me for that. So, but
That
yeah,
has to make it a lot easier.
absolutely. So yeah, and I really think like a lot of people like you listen to Bigger Pockets or you listen to other like bigger shows, and they're got these guys with the empires and hundreds of rental units, and like you need to treat it like a business and stuff like that. It's like I enjoy the landlord stuff. I enjoy fixing things. I enjoy doing stuff like that. And like I don't really want more than 15 units. And like sure, over time that those might change and it might go upgrade to 15 better units or 50, whatever it is. But like at that point, I don't have an interest in growing more. I don't have an interest in incurring more liability than that, because I know at that point I'll be at a really comfortable spot.
Sure.
So
That'd be amazing. 15.
yeah, yeah.
Well, I'm sure you've seen the numbers on these like claiming residency multifamilies where you can get cash on cash returns of upwards of like over 30% on these places where like, after expenses of like CapEx and stuff like that, because the amount of money you're putting into these places is just so low. Like for this duplex, it was like $33K out of pocket altogether. And, it'll be, once it's fully rented out, I'll be, having this place paid off in like 2.5 years. So it's like that initial investment paid off. So like if you can do that 4 or 5 times,
It's easy.
Your passive income is going to be well over a few $1,000s. And then, it's a lot of work though. It's not easy at all, having to convince your significant other to move with you to all these new places, trying to find the best deals. And I was in the same boat as what you mentioned. You weren't like pressing yourself to go immediately after the next year, because especially with how things are now, the market's crazy. Like, are you going to find a deal? Are you going to get screwed if you stick to that year? How's that going to work?
Yeah, I try not to put too much pressure on myself, like you were saying. And there are certain things that I want to do to my place too. So that's kind of playing into my idea too. It's like, okay, do I invest any more money into my place before I move out, or do I just save that money for the next thing and just be like, yeah, it's good enough. Like it's in rental condition. It's not like the Taj Mahal, but it's.
It's funny you say that. Craig, he's been on our show. He does another podcast. He like wrote the book on house hacking. He worked at Bigger Pockets. He like really did a lot with that, and he's encouraging like a huge community in Denver, Colorado to be taking advantage of this and buying single family houses and renting out by the room. And
oh, wow.
When I was talking to him, because I was on his show and we were talking about like the amount of sweat equity I'm putting in and the amount of time and labor, like, because I do everything myself. I'm not hiring out much. And like with that, if the same deal was available for $15,000 more and it's turnkey, in the term of the loan, it doesn't make any difference. Like it makes a very insignificant difference in like the actual cash flow and stuff like that. So like buying with it already good to go, paying a top dollar for that is what he encourages. But I'm big on, I like doing the stuff myself. I like having kind of the pride of
find the dumps on the market and get them for cheap.
yeah. So that's but it's a valid point, and I think there's both ways you can look at it, because he's saying like you put $25,000 into the rehab to increase the rent by $200 a month.
$200, right? Like
it's
how
like,
much can he really increase?
So if you would have just kept it there and put $25,000 into another duplex that you're going to get
right.
another $700 a month in cash flow, like which is better? And it's like the other duplex.
Or just do what
right.
Dion does and walk into his brand new rental he bought and just convince the tenants just to pay him more and do nothing.
That is what he does. It's actually a really, here's out, but it's a really good strategy that I'm definitely going to implement later. But for inheriting tenants, he creates a binder, and he has a picture of the property, of the apartment, the list price, like what he paid for it, and he goes in and is like, hey, these are all the comps. This is what all the apartments around you are renting for. And if they're paying $600 a month and the market rent's $1,200, it's okay. Those are all the rentals around you. This is what's available. These are the 3 that are available, and they're like 14, 15. Like, if you would lose your house today, like, this is the realm that you'd be stepping into.
Then you just ask the question, like, what do you think is fair? What do you think is fair? And then they're like, all right, if any normal person would be like, I'm going to screw this person over if I don't pay any more, then I want to stay where I'm at, and then they pay more with that. And then you don't have to do anything at all. Like, no remodeling, no $20K remodeling the apartment just to get $300 more a month.
That is ingenious. I know. The idea.
I know. I think his book's gonna come soon. He's talking about it.
We were hyping him up on the book because we want all the details on that. I want to get a copy of his lease too. I just want to see how he does that. But
yeah. So
going forward, I want to talk a little bit more about like the finance side and just like what do you see for like how crazy things are right now? Like, what are your, I guess, the one specific thing, like the 1031 situation going on? I'm sure you're probably like a little more familiar than we are on what's happening with that. Like, I guess they're just rumors of it getting axed, or at least lowered how much money you can save. What are your thoughts and feelings on the environment of finances right now?
Well, the 1031 thing is interesting. We can start there. I was surprised when I heard that they were potentially going to be doing away with that, because I didn't see the benefit from the IRS, if you will, or whoever gets to make that rule. Why would you want to take that off the table? But that's neither here nor there. That's probably a different conversation. But I have not heard one way or the other what's going to happen with that. And to be perfectly honest, in our line of work or doing mortgages, I've done like 3 transactions where there was a 1031 exchange involved. And really, from our standpoint, we're not really that far involved in the 1031 exchange. That's all done like by somebody's attorney and the title company. We just care where the money's coming from, so we can source where it's coming from, and then they obviously get the benefit of not paying, I guess it's capital gains tax, or
yeah. So it's where you were saying like where's the benefit in the IRS taking this away, because it's almost what I've heard, and this was from the One Rental at a Time podcast, but he was saying 8 to 10% of all real estate transactions involve somehow a 1031 exchange.
Wow.
Which I don't know how accurate that is, but he said it on his podcast. It's on the internet, so it must be true.
It must be true.
But in conjunction with the 1031, they're raising the capital gains tax. So
I did hear that. Yeah.
If they're doing both together, it's going to be a slam dunk for the IRS. They're going to make a lot more money, but at the same time, a lot less people are going to sell.
Yeah, I was going to say.
So it's weird.
If you raise the cost of something, people are just going to move away from doing it. So we're just going to see less supply.
We're going to see a lot more seller financing.
Yeah, true. Hopefully, fingers crossed. Yeah, going back to like the real estate market, you're still working, dawn till dusk doing financing and refinancing.
Yeah, it's slowed down a little bit over the last month and a half. Like, we've seen a pretty, in my mind, because I watch rates every day, and I think of where rates were 6 months ago, and I see them now. But you got to bring it back. Like, this time last year, we're still like 0.25% better in rate than what I was offering in May of 2020.
Right.
So you figure historically the rates are still like super low. There's plenty of people out there that can benefit from refinancing and are still getting some of the best mortgage rates ever. It doesn't have a 2 in front of it necessarily anymore,
right, but who cares?
But it's still like super low.
What are we sitting at right now? Around
3.25, 3.375 with like no points out of pocket. And then depending on if you're doing a pretty large down payment, I mean, you could definitely be in the 2.99, 3% with a small amount of points as well. But you're hovering right around the low threes.
You guys aren't dishing out them 2.7s anymore?
Unfortunately not. That was a good I am gonna tell you that I had told people more than once, I was like, rates can't be in the 2s. It's just not possible. And I'm like, this 3.2 2.5 rate like that somebody would have gotten in like 2017 or whenever the last time we had like a really good market was. I'm like, you're never going to get out of this loan. And all these people that I refied last year with the 2 in front of it were like, Dylan, you told us this was never going to happen. Like, are we going to see a rate with a 1? Like, should I even be doing this now? And I'm like, well, let's not get carried away. I mean, I don't think it's ever going to go that low, but
So do you really not think so?
Time. Well, here's what happened to get rates in the 2% anyway. They were all subsidized by Fannie and Freddie. So when we do these bond auctions where mortgage companies like the company that I work for sell mortgages on the open market, because obviously we only have so much capital, so we can't hold every mortgage that we originate, because then we won't have any money to lend to somebody else. Like eventually, like you're just going to give out all the money you have. So they hold these bond auctions, and the only people that were buying mortgage-backed securities when rates hit the 2s were Fannie and Freddie, were the federal government buying these mortgage-backed securities, and they were buying them to the tune of like billions of dollars or trillions, I think, if you calculate it all together. And so no private investors like Bank of America, Wells Fargo, some of the larger people that actually hold mortgages were buying them. And so they were all subsidized rates. And so the free market was looking at those rates in the 2s saying, we're not touching that. We don't make enough money. We don't make enough return off of a 30-year note at a 2.75 rate, or it's really like a 2.5 coupon rate is what they call it. And so unless the federal government comes in again and has to keep the mortgage industry going or housing industry going to help benefit the economy, I don't think we'll ever see rates in the 2s again. And 2, I don't see how it could go lower than that, because at some point it's just not going to make sense for them to do it either.
2 questions on that. One, the one is Fannie and Freddie are the only ones buying the loans, but who are you paying then? Like, because you're saying like, Wells Fargo wouldn't touch it, but it's like I'm paying Wells Fargo. Who do you actually pay in that instant?
It's a great question, and I'm going to be honest. My knowledge is somewhat limited in how it works, but I know, like, for example, my mortgage is still held by Cross Country, the company that I work for, and I pay them every month. They're the servicer of the loan. So they collect my money and make sure that my homeowner's insurance and my taxes get paid when they're supposed to get paid. But Cross Country Mortgage doesn't actually own the loan. So somehow in the background, they got paid back the money that they lent out, and then they're servicing the loan, I'm assuming, for some type of a fee. Mm-hmm. But that end of the business, I don't fully, I'm not going to pretend to be an expert on.
Okay, no, but it makes more sense in my head than it did before. And the other thing was, so if we follow trends, we go, a lot of things from the U.S. go Canada, and Canada's kind of going from Europe, and like we see a lot of kind of that trend with a lot of things. We've seen 1% interest rates in Canada, and we've seen negative interest rates in like Denmark. So what's your thought on that? Like, because if we do follow a trend, why would anyone have any incentive to give it a negative interest rate? It just doesn't seem sustainable at all.
I would agree. Yeah. And I don't know the specifics of how that happened in those 2 countries, but I would say that it's not indicative of a strong economy either at that point. Like,
absolutely not.
I think that's like I could be wrong. I think that's kind of like a last-ditch effort on their part from like some type of total financial collapse just to keep things moving, because real estate's moving. There's all kinds of other industries that follow real estate that keep them in business and at least having money being moved around.
Yeah.
I think it actually makes a lot of sense, actually, from what you said earlier about the government pumping money in, buying the mortgage-backed securities in the first place, where the U.S. government pumps trillions of dollars in, but we have so much supply of houses that it was only able to bring the rates down to like 2.7. Versus those other countries, if they pump in tons and tons of money into their market, they don't have nearly as much supply. Canada, you're looking at 39 million people. Denmark, probably not more than that. So the amount of houses that they have compared to the U.S., where like we have one of the craziest real estate markets in the world, your money you're subsidizing with will have a greater effect on the interest rates you're getting back for those loans. So I think it makes perfect sense as to why
That does
you
make
would
sense.
see it over there and not over here, just because they have to put in hundreds of trillions to get negative interest rates. If they put in trillions, it only knocked it down by 1%. You know what I mean?
Right.
So,
Right.
Going from there, I was kind of curious in like the actual process of becoming a loan officer and
Yeah.
like the perks for an investor. You know, so I'm big on like got my real estate license so that I could do my own transactions. I'm learning this skill so that I can do this to my properties like all the time. And I wanted to ask you, like, in your opinion, would that be something worth getting for a real estate investor? What are the perks associated? What's the requirements associated to get your license? Like all that kind of stuff.
It's a great question. The one thing that's interesting about mortgages versus real estate, like real estate, you're basically self-employed. Not basically, you get a 1099.
Mm-hmm.
Mortgages, they don't, or mortgage companies, they don't allow us to be 1099 employees. They require loan officers to be W-2 employees. So that means that the mortgage company has a vested interest in you because they're paying Social Security, they're paying unemployment, they're paying, I would assume they have to offer you health benefits. So in my industry, I don't see very many people who are in this job who are part-time or not doing this like this is their job, this is their main source of income. And one of them being the bank, just at least the bank that I work for, is just not going to be interested in taking on people that aren't going to produce enough for them to make it worth their while to do all the things that they have to do on your behalf.
But don't loan officers get paid on the commission as well?
We do.
So how does that work? It's siphoned through the bank, like.
Yeah, so they pay you a commission like a car salesman or somebody else. Like it comes as a W-2. They pull all of our taxes out. It's just not a consistent amount every pay.
So is that hard get qualifying for a mortgage? You know, being a mortgage officer?
It is.
Without consistent income. Seriously.
Yeah, no, seriously, it is. I agree. So that's what it takes. I think that's one of the reasons. The average age of a loan officer is like 55 years old or something like that, which is crazy to me. But there are like no young people in our business. And I think part of the reason why is because it's so hard to get into the business. You can go a long time while you're like building up clients or building up realtors, you know, till you start making a paycheck that you can live off of. So it's hard for anybody to get into it. And then there are other options. You can go work for a bank and you can, a lot of times they'll pay you like a base salary and then a smaller commission structure where the majority of your income is stable. But they kind of churn and burn people. Like you're cold calling, you're dealing with all kinds of stuff. And I think it just burns a lot of people out and they just decide it's not worth it. It's something that's going to have to change because at some point, like our whole industry is going to retire and there's only going to be like a handful of guys left. Like, yeah.
Right. Oh, man.
Or they just write the AI that replaces the loan officers
and the real estate agents and everybody.
The accountants.
Yeah.
Yeah. And AI is great. I mean, it certainly makes my life easier. As I was saying before, I don't have to, when I first got into business, like it wasn't that far for me to like, or out of the question for me to like spend a part of my day like driving around to people's houses and like picking up their tax returns and stuff like that. In this day and age, I would never do that.
Right.
Like there wouldn't be enough time in the day. And so obviously AI, that's not AI, but the online and advances that they've made in technology to help us out are amazing. But I think it would be tough to replace both real estate agents and mortgage companies completely at this point.
Absolutely. And especially like we had Todd talking about this too on his episode, but he was saying like there's a difference between like me giving you my salary and my savings and you pumping out some automated number opposed to the conversations that we have of like, no, what's actually the best thing for you to do? Like that you need to know that there needs to be some brain behind that.
Yeah, like associating your goals and stuff like that. Like, what do you want to achieve? Like with the house, is this a permanent deal? Like versus the computer, you put in your income and your expenses or whatever, and it spits out the max, and you're like, sign me up.
Yeah, like, exactly.
Done.
So when you started with Todd and you're driving around pulling staples out and doing all that stuff, like were you taking your courses to become a loan officer? So that was during that time that you were doing that?
Exactly. And I would say most of the people that I know that got in the business that are younger like me, they got into this business by working for somebody like a Todd who was established enough. He had enough clients. He just needed help with simple tasks like an assistant who can learn can do. So he was able to pay me like a consistent salary for a certain period of time until I got licensed, finished all my classes, and could start, actually doing loans myself.
So you just said that there's a conflict of interest with the bank and you personally. So were you able to get like a better deal than the rest on your mortgage? Like how did that benefit you in your house buying, being your own law officer?
So I'm not allowed to be my own loan officer. I know because I know what I was able to work up my own pre-approval essentially. So like I knew what I could afford and what I couldn't. But technically all the name on my paperwork would be from somebody else. And each mortgage company, to my knowledge, all the ones that I've ever been associated with, have like a certain one or two people who that's like their job at the company is employee loans and close family members of employee loans. So like they even take it a step further where like if my parents wanted to do a mortgage and they obviously have the same last name as me, like I technically couldn't do their loan either.
Really?
And I don't know that that's like an industry standard Fannie Freddie rule saying like, no, you can't do it. But I think because we're selling our loans on the mortgage-backed securities market, like the end investors essentially are leery of that.
Sure, which makes sense.
Thinking that there might be some kind of fraud that could have happened. And so they just basically, or at least our company just basically says like, it's a no-go, that you have to send it to the specific team that handles like employee
So I guess
loans.
that answers your question. Is it worth being your own loan officer? And you literally can't.
Right.
You literally
And because
can't.
of loan officer comp rules, the crazy thing is like, I don't even get like, they do give you a little bit of a incentive to like use cross country, but it's not crazy like you would think.
Like a few points or something like that. Like you can they give points towards it or.
Basically what they did for me, like our loan origination fee is $11.98, so it's $1,200. They waived that. But then like rate wise and everything else, it's the same.
So basically you're paid in your knowledge, like being able to have the right things in place to qualify for the best rates and do all those things. Like that's your payment, and if anyone has that knowledge, they can, besides for the origination fee, like besides for that incentive, it's pretty much a wash at that point.
Yeah.
I was going to say, it's not like being your own realtor where you get that 3% back or whatever.
Right. And honestly, I think if anything, it kind of makes sense when you think about it from like a consumer financial protection, if you will. Like there's not these crazy deals out there that, I mean, obviously everybody's fees can change from bank to bank. They're going to be slightly different, but like, there truly is like, that's what the costs are. And there's not some smoke and mirrors in the background where like everybody's just playing the consumer.
Yeah,
Twist the dial back real quick and get a 1.9 or something.
Yeah, like
that.
that's
Right.
kind of that's what was in my head, that like, there is that wiggle room, but I guess there's not. But for, everyone listening, for us, anyone looking to buy properties and get the best rate, and what is your like, go-to tips, that you can go with all of them, but, stuff that most people might not know.
Yeah. Well, like you were saying, everybody's situation is slightly different.
Yeah.
So I think, depending on how much cash you have, what your goals are as far as how long you want to stay at the property, how many of these properties do you want to buy, that all comes and plays into it. So, for example, if you were comparing a conventional loan for like an investment property for a duplex versus like FHA.
Mm-hmm.
The benefit of the FHA loan is you can put less money down. The bad part of the FHA is you're stuck with the mortgage insurance for the life of the loan.
Or so until you refinance at 20%.
Until you refinance, exactly. So like maybe not the full 30 years, but until you get out of that loan,
right.
Yeah, you're going to have mortgage insurance. But so, somebody could come across and they could have the money to do 15% down or, whatever that maybe even 25% down. But you kind of have to ask them what their goals are. Like, hey, maybe it makes sense for you to not do that much money down so that you can buy another one if that's your goal. Like,
Yep.
Keep some cash aside. But obviously the benefit of putting more money down is you're going to be more cash positive because you're going to have a smaller loan amount. You're going to be getting more rental income.
But it's like what we said earlier about the rehabs. It's like, well, which outweighs the other one more? Like, being a little less cash positive because you're paying PMI, but then you have the money to do the next deal, or just pay the PMI. So
yeah. And so it's different for every person, but I think you got to look at what their goals are. And I think finding the right property, having a real estate professional is so important too, because from the financing side, like I can show you what things cost to borrow the money, but you got to find the property that's going to rent well in an area where you can get a decent tenant. It's not going to turn over every year where you'll have to come in and repaint or go 1 or 2 months without any rental income because you're trying to find somebody else. Like the real estate professional is really going to help you do that. Plus, or tell you just simply if you're overpaying or if it's a good deal. I mean, that stuff I necessarily couldn't help you with.
Sure. And I think that's kind of somewhere where I see myself going at some point, just working with more investors, because a lot of agents, aren't investors or don't have that that's
not their
specific
expertise.
Exactly. So, finding that person,
personal.
Exactly.
Mm-hmm.
Finding the person who's going to be able to go through that stuff, like, hey, this is what I did and this is how this worked, and I know this area is going to rent for this much. Like, most realtors don't know that stuff, and they don't need to, because people are finding their forever home that's beautiful, and can they afford it, So it's two different ball games. But so I know, and we had the same kind of thing with Todd, but it's because there's so many different aspects. Everyone's got different situations. Everyone's got different goals in mind. But focusing in on like our audience, right? A bunch of 20 to 25 to 30-year-olds, okay income, a little bit of savings, looking to house hack, like start building streams of passive income. Like do you have any like tailored tips or something for that cut of people?
Yeah, it's a great question. I would say, I would probably say, like, as soon as you have the opportunity, take it. Like, don't wait for anything. I probably could have bought something 2 years ago, and I didn't, just because of things in my own mind. I didn't think I had enough money. I didn't think I was ready. And now look at what happened. Like, that house that I bought for $325 probably would have went for like $250.
Right.
3 years ago. So you figure, just look at that lost time that I had. So for people that are kind of on the fence, who are potentially ready right now, like, seize the moment, take the opportunity. You're going to see the housing market is not going anywhere, and values are not going anywhere. They might level off, but they're not going to all of a sudden tomorrow go back down. Things rarely ever do, unless there's like a real negative event that happens in the economy. So that would probably be my biggest advice, is if you're on the fence, reach out to a mortgage professional, figure out, if you're not already, figure out where you stand and what's possible, and then get out there looking and start building your empire.
Yeah,
absolutely. I think like one of the tools you guys offer with the calculator of getting the full rundown of like how much everything's going to cost, from like the insurance to the taxes, and being able to like tailor the down payment percentage to be able to hit a certain monthly cost is just like such an important tool to have, especially for us. Like, we see a deal, be like, yeah, you can get this much money comps for rent. It's going to cost this much. Like, it's just a listing price, like $325. Like, what does that mean? You know what I mean? So
Sure.
Like, that's something that you guys offer, and it's super useful. And I wanted to ask, is that like just like a manual process you guys do, like putting all that together? How long does that take you to do something like that?
So it's great that you brought that up. It's something that Todd and I, it's so labor intensive and can take so much time, but it's something that I just can't get away from, because like you said, I feel like, how do you buy a house without that stuff?
Right.
Yeah,
so many people do, but like, how do you go forward without knowing roughly what this thing's going to cost you on a monthly basis and how much it's going to cost you out of pocket? I wouldn't necessarily need to do the full rundown like I do for everybody, but in order to tell you what you owe out of pocket and what your monthly payment is, I already have to do this in the background. So spending the time making those estimates, I just feel is the most important service that we can offer people. And it takes, I would say, like, if you reached out to me and you were like, Dylan, this house is on the market, I want to see it for $330, $325, and $320. The first initial setup, getting the property taxes, running in all the third-party fees, title fees, all those quotes, it takes about 20 minutes. And then to switch it between different purchase prices can take 10 minutes additional. The majority of those things stay the same, but for an example, if you're in a conventional loan and you have mortgage insurance and you're switching at those down payment amounts, it's not going to change your debt to income ratio significantly. But like your mortgage insurance could change if you were going in at the house at 350 versus 300 because you might cross a threshold there. And so in order for me to give confidence when I'm sending out one of these estimates that I'm right, I do spend time and I'll run those different calculators for every purchase price, and it takes some time.
It's
but
all thresholds, like you said, like the numbers for credit score, especially if you get over like 1 point or 2 points or whatever onto the next threshold, you're cheap. It's a lot cheaper now versus more expensive. So yeah, I could see, like, I make these reports myself, trying to like replicate how you guys did it, like so I get a better estimate myself. And yeah, it is a lot of checking, and then like having the confidence to say like this is pretty close. Like I know I'm not confident at all in my calculations. It's very rough. But yeah, I could see how that would take a decent amount of time to run all that stuff.
Because nothing's worse than you taking the time, sending somebody numbers like this. And obviously there's so much that goes into it. It's so detail oriented, but to have a mistake, it's like, I have nightmares about it. Just because I feel horrible. Like I take pride in what I do. So to have a mistake, like, when we make mistakes, it has real consequences for people and in dollars and cents. So it's a lot of pressure.
Yeah. I'm sure it is. I feel like that'd be so much pressure, but something that I really like appreciate about how you guys do it is like all my loans, they've been over. You guys err on the side of caution, and instead of the other, where I know other people, other mortgage companies will err the other way to make people feel good about trusting this guy because he's going to get me the best rate. And it's like, it's not that. It's very different. Like when you send me, my monthly payment's going to be $1,300. I'm like making sure that my numbers work off of $1,300. And then when
in reality,
in reality, I know it's going to be a little fuzzy there, and it's going to be fuzzy in a good way. So it's
exactly.
I really appreciate that you guys do that way.
Thank you. Yeah, it comes with confidence. And Todd obviously had been doing this a long time and taught me everything that I know. And he had told me like, those other mortgage companies that do what they do, where they're not even necessarily undercutting, but in some cases undercutting, like showing costs lower than what they'll actually be. It's because they're in competition. They're just trying to sell the loan, where like we take a different approach. I'm not trying to sell you the mortgage. I'm trying to prepare you to buy a house. So like, I'd rather show you that it's going to be $2,000 more than what I actually think it's going to be, so that one, God forbid something does come up that I can't plan for. Like, for instance, you owe, sewer or water prorations back to the seller. That like, how would I know that? Like depending on where the house is, but over preparing people so that the day of closing, it's less than what we're telling them is, I feel like, the best service you could do for somebody buying a house. So that's the approach that we take, versus just trying to show them the lowest number that if they go and call 3 other banks, it's, they'll get 3 different answers probably. But
yeah, I mean, from my personal experience, it was pretty nice, like getting that extra money back after settlement. I got the check, the check after my cashier's check I gave to them. They gave me the extra money, and I was like, wow, that was like a few $1,000s I thought was gone. So I'll take that any day.
Yep.
There's always something to be done with that money, right? You can, even if it's just sitting in your bank account.
Yeah, 15 gallons of paint.
Yeah, I wanted to get a little more specific. I want to use this time selfishly while I have you.
Sure.
I'm looking at I've already sent over to you the stuff that I'm considering, but I wanted to dive into the 203K loan and kind of talk about some specifics of that, because we've mentioned it on the podcast, but neither of us have done it. We've done our research on it. And it's like, it's the rehab cost is lumped into the purchase price, and you put 3.5% down on that. That's great. But like, I wanted to kind of get into more of the intricacies on like what you guys require to do something like that, and like, that kind of stuff.
Yeah, absolutely. What I will start by saying is we've done, I'm surprised we haven't done more of them in the last year. Although I will say that I think as inventory stays low, we will see more people interested in doing 203K loans or renovation loans, not just one, because the houses that are available on market might not necessarily be completely turnkey, but I think you might get people that decide, instead of selling their house, hey, I might just stay put in my own house and fix it up, that because I can't find what I'm looking for. But I would say that one of the key things about those renovation loans are, because of how expensive it can be to do, not the loan itself, although the loan's going to come with higher interest rates and stuff like that, but you have to hire everybody to do all the work. It's really made for people who are going to like stay in the house. If you were to look at like a short term, when do I get my money back thing after like investing it, I guess it kind of depends on how well the market is appreciating. Mm-hmm. But those programs are really designed for people who are like, I bought my forever home. It needs a $30,000 kitchen and I want to put an extra bedroom on. Like, here's the money to be able to do that. It's hard, or I've never seen anybody use it for the purposes of like flipping a house. Mm-hmm. And not to say that that's what you were asking about, but it's just something to keep in mind. Like, I've never seen anybody do it that way.
What I'm hoping to achieve, right? I want to maximize my FHA loan. I want to get the most cash flow I can at the least amount of money down. Mm-hmm. So with that being said, I've sent you a few 4 units, and where I'm perfectly capable and have the cash to do those rehabs with just a normal FHA loan. But the difference is, a lot of sellers in this market have no interest in going through all the jumps through the FHA loan.
Yeah.
So when less people want to do the work and have that responsibility of taking on the FHA loan, and they're like, we're only taking cash and conventional, the 203K loan is my angle to get my foot in the door of like, hey, all that stuff's my responsibility now. I'll take care of that stuff. And it's funny, I'm actually working it out now with a contractor that I'm going to hire onto their books and be an employee of the contractor, and they're going to pay me hourly to do the work because it's so hard to find a contractor right now. So I know with the more interest rate and all that stuff associated, my monthly costs are going to be higher, but if it makes sense, it's great. And my other thought, because originally it would just be to go through the FHA checklist, make sure everything's safe, that kind of stuff. But we were talking about it the other day, like if the ARV is this compared to the purchase price, and I take this loan on and do X amount of work, and now all of a sudden I have 20% in equity because the ARV is this and it appraises at this once all this stuff is done. Mm-hmm. I can refinance and get out of all that stuff earlier than without. So what's your thoughts? Like, I want the pushback from you. Like, why, Jake, why you're being an idiot, why that isn't going to work. Like, I want to hear that.
So from the bank's perspective, I will tell you one thing. We don't want to know that you're going to be doing some of that work or that you're working for the contractor.
That's what I thought too.
This was all hypothetical.
Exactly. And the reason being, they are just nervous that, or the bank, the product, the way that it's designed, they just want to make sure that that the work's being done correctly. Mm-hmm. You're not the people, you're not the person that they're worried about doing this work, right? Like, what you're doing, yep. You have experience, but there are other people who are like, yeah, I can take that on. And then all of a sudden they get like halfway through the project and like everything's messed up. And then like, what happens then? Like they can't even sell the place because it's like half finished and half done wrong. Yep. So that's why the bank just doesn't like that.
Which makes sense, which is the whole reasoning for needing a licensed contractor. And I have the skill set where like I could go work for this contractor. Like I have no qualms with that. And I've heard on other podcasts, other people have done it successfully, and that's why I was like, maybe it's a gray line, but it's working with the system instead of against it. But so by building in that sweat equity, and even if it was all done by contractors and I did nothing, that doesn't even matter. That part of it doesn't really matter. But how would that process look like? So the house is $500,000 and the detailed bid from the contractor is $50,000, and he's going to hit all these checklists. That's going to get to our ARV of $650,000. My loan is for $550,000. That other $100,000, and I already have some equity in, would get us close to that 20%. What would your thoughts be on doing that program and then paying the rest to in cash towards principal to hitting that 20%. Does that make sense to do?
In certain situations, absolutely. And we tell people when we're doing these loans, like if it's their primary residence, all the time, that this is a means to get the work done that you want to have happen. This is not your end loan permanent financing. So it's always like a two-step process. You don't have the equity that you need right now. In your case, when you're buying it, you want to be able to put less money down. So that's why you're the 3.5%. But let's say we were doing it as a refi instead of a purchase. Your home doesn't currently have the equity, so we have to do a renovation style loan so that we can do the after improved value instead of what the current value is. But at the end of the work being completed, you need to make a minimum of 6 payments on the loan, on the renovation loan itself. But then after that 6 payments, and assuming that the work's already all done, we're going to take a look at refinancing this loan to get you out of mortgage insurance, hopefully a better rate if the market is cooperated, and then you're into more of a permanent loan in probably a conventional situation. And that is our goal almost every time that we do one of these loans, is to switch it over to that type of financing in the end. You do pay some closing costs twice, but the end result is the house is fixed. You got all the sweat equity, if you will, built into the now end loan structure in a conventional scenario. You were able to finance the costs of doing so.
Right.
Sorry to cut you off there. I was curious, what cost difference are you looking at for the interest rates for the life, like for the 203K versus a traditional FHA, or like without the 203K?
Yeah, they used to be much, much worse. And in the recent years, I don't know why. I normally like to find out the why whenever I see something like this happens. But to give you an example, 203K rates, like if the going rate was like 3.375 on a normal FHA loan, you'd see an FHA 203K loan at like 3.75. So it'd be like 0.5% difference in the rate, which in my opinion isn't terribly significant considering the benefits that you're getting and the fact that you're not staying in that loan long term anyway. It used to be like 1% higher. And that was a harder sell in a sense. But again, if you think about it as this is a means to an end, this just allows you to get the project done. Like the interest rate's almost irrelevant.
Yeah, true. Especially if you're in a shorter term. And that brings up the second part of doubling down on the closing costs. And so that was something that like we've always tried to figure out when we're calculating deal prices of like cash to close. And I was curious about like the correlation of how much a house costs to how much your closing costs are going to be. And like, does it correlate with the down payment amount, or like, because we've just recently just been taking the down payment and doubling it. And we've been kind of close to see like, that's what closing costs are, at least for our range of deals. So I'm curious to get your opinion or like your perspective on like how, like where the closing costs come in and like why they are so much in what circumstances. It's
a great question. There are some parts of closing costs that are fixed. And so if you were buying a $100,000 house or $1 million house, that is the cost is the same. So, one thing, the easiest thing for me to talk about is the origination fee that the bank charges. That stays the same no matter what the loan size is. Appraisal, once you do get above like a $750 purchase price, they do charge you a little more for the appraisal. But essentially, that's going to be a fixed cost too. Transfer tax in the state of Pennsylvania, it's typically 2%, 1% is paid by the buyer, 1% is paid by the seller. So that's going to change with the purchase price of the home. Lenders, title insurance changes with the size of the loan. And then your owner's policy changes with the size of your down payment, essentially. So a lot of the title fees are not fixed. Well, actually, the majority that lender's title insurance is associated with the purchase price and or loan amount. But then there are other fees that they charge that are just, they are what they are. Commitment fees like $125. And then taxes, what we're collecting in prorations. It's hard for me to say like an exact percentage, like, oh, you can always factor like, hey, it's 13% of the purchase price is what you're going to pay in closing costs. Obviously, that's a crazy number, but whatever that, it's hard for me to say. Yeah. I've never thought about it in those terms, but a lot of the costs are fixed and are going to be the same. And then there are a handful of them that will change with the loan amount / purchase price.
I'm definitely going to be playing this back and writing down all those different steps that you took, because all that stuff, like you're saying, it's dependent on how much you're putting down and it's dependent on the purchase price, it's dependent on the taxes, it's dependent on all these other things, but you can calculate it. You guys calculate it, and it's by
Sure.
but it's by knowing, and it's just the knowledge that, that's what we're after. So
Yeah.
Does
that's
that
awesome.
the closing costs, do they change significantly doing a residential versus an investment deal? Like 25% down, like I'm buying a duplex for other people to live in versus a residential house that you're buying for yourself, live in duplex kind of a deal?
No, I would say most of those closing costs aren't dependent on the occupancy. Trying to think if there would be a situation where that's not true. No, I think the only thing you'd be looking at is just potentially interest rate differences in the occupancy and down payment requirements. But I would say closing cost wise, multi-unit versus single family or investment versus primary, I don't think there are any differences in title fees, transfer tax, anything like that. No, I don't think that there are.
Cool.
That's good to know. Yeah. So going back to the occupancy thing, now to the 203K loan.
Yeah.
So I'm assuming that during the rehab, you wouldn't necessarily need to claim residency. What's kind of that window? Like, I buy something with an FHA 203K loan, I'm claiming residency there. I'm going to live there. What's that buffer room? Like, where at what point do I need to start claiming residency from settlement date?
I would say when the project is done. By the time that they're giving the final disbursement out of your escrow or rehab fund, if you will, that they're setting aside, because they don't pay it all at once.
Yep.
It's paid on draw schedules that they will determine prior to closing, but depending on the size of the project, maybe there's 3. I don't think they like to do more than 5 draws. But anyway, by the time that the final payment gets made, they're going to say, hey, we want you to be living in the property then at that point. But obviously there are going to be some renovation scenarios where you couldn't live in the property while they're doing the renovation, and there's they obviously don't have a problem with that.
And would your like minimum of 1 year living there start then, or does it start at settlement dates?
It's a great question. I would say it would probably still be based off of the settlement date.
Schedule them 11-month remodels then, and then you never know to move in.
No, that was a genuine thought for me, because August is my year of residency at my current spot, and my thoughts are, with the amount of work that I know is going to be necessary, if that takes 2 months, I will be claiming residency at the duplex I'm currently at for a full year, but I'll have done settlement 2 months early. You know what I mean? And I know that's kind of like a wiggle room, and it's with the intent, like, did you actually live there? Were you planning on living there? And it's like, yes. And if you can answer those questions genuinely, I don't think, based on what I've heard, it's not a big deal. But what are your thoughts on that?
I agree. It's not a huge deal. They want to make sure, what they're really trying to prevent is like they want to make sure that you're actually going to move into the place, and that your intention is to live there, even if it's for a short period of time.
Yeah.
I've never come across any like steadfast rules or had an underwriter throw that at me. Like, hey, this guy just bought this place 10 months ago. You'd be like, well, circumstances changed and he's moving. Like that happens all the time.
Right.
So.
Right. No, that's awesome. And then the other thing we were just talking about was the vacation loans.
Okay.
I've been considering, stepping into the short-term rental, like having a vacation home that, you can't do a long-term lease on, but you can rent it out weekly, or, if it's at the beach or whatever, you're able to do that. So I'm thinking like, okay, 10% down for the vacation loan, conventional. Like that's a great resource, for, potentially a vacation home and another source of income where at least I could break even on the mortgage and kind of house hack a vacation property is kind of my end goal. So like, when we were talking about that, you had mentioned that I wouldn't be able to use my rental income to offset the debt to income ratio that I currently have, and that will accrue with this next property. So what's your thoughts there? Like, would it be worth doing? Is that something that's doable? Are you allowed to get a vacation property that you're planning on sometimes renting out? Like where's the line there?
I have ran into this once before. Luckily, this particular individual didn't really need the rental income, or he didn't need the rental income from that vacation property. So it didn't prevent him from buying anything else after the fact.
Mm-hmm.
But they will allow you to rent the home on, I'm trying to think of the exact wording that the underwriter told me because on his tax returns, he tried to refi the place like 2 years later that we had helped him buy as a vacation home and not an investment property. The rental income that he was claiming on the property was very small, like $2,000 to $3,000 for the year or something like that. And they were saying like that was okay because, and the fair market rental days that he had on the property was like 18 out of the 365, and was saying that he used the rest of it for personal time if he was there at all. If you're buying it as a vacation home, they're not going to and then if you bought the vacation home in like August and then November you were going to buy another investment property, you wouldn't all of a sudden be able to turn around and be like, hey, this place is renting for
right,
$1,000 a month, because you just bought it saying that it was your second home.
Right.
And it's not that you're not allowed to rent it, but that wasn't your intention, was to like profit off of it. So you're allowed to rent it out when you're not using it to friends or family or whatever, but they're not going to give you the credit then to offset that debt as they would with like a straight up investment property that your intention is to rent fully all the time.
That makes sense. So is there like a gray line though? Because like, he had it on the market for 18 days out of 365 and made $2,000 off of it. Like, is there like a line that like you can rent it out for 150 days as long as it's less than half of the year and you can make this much on it? Like, what do you know those
from
specifics?
The wording? It sounds like is you just rent it out when you're not using it. I don't think it's similar to like staying there, like living there for a year. It's like your best effort. They're not gonna like put a gun to your head and be like, you have to live here at this place 184 days or else.
Right.
It's kind of just up to the loan officer, like you said. And when they look back at your tax returns and see, you Airbnb this place out and made $80,000 for the year, on this one property, and you're trying to claim that, you said it was your second home. That's kind of sketchy, so it's just kind of.
But like, how often do people normally use a vacation home? Like a couple weeks out of the year,
yeah, that's it.
And like, what's it doing the rest of the time? I think it's wasteful to not.
Yeah.
I don't know.
And I'm with you. I'm with you. I think what Caleb was saying is true. There's not like a hard, fast line, but they just don't want it like thrown in their face either. So I think if you bought that place as a vacation home and then like the next year you bought something else and we were looking at your tax returns and they saw rental income, I don't think anybody would question it or talk about or question your truthfulness and when you bought the place. But to your point, I think that's exactly how
it's like an ethics question. I think it comes down to, not a legal question.
Right.
Yeah.
Right.
Yeah.
No, that's good.
We've been keeping we've been both looking at properties down in Florida for a couple of weeks now, just eyeing them up, being like, man, flights down there are like $60, and
it's warm all the time.
Yeah. And we're both about to turn 25, so we're gonna get some cheap rental cars coming up pretty soon. Right now, they're crazy expensive.
I know. It's so expensive to rent cars when you're not 25. It's like they'll tack on an extra $100 a day or something crazy.
Yeah, it's like $1,000 a week for us to get rental cars. It's so insane.
No, but I know I've been looking in Puerto Rico as well, Florida. I was originally looking in like the Carolinas and stuff, but it's like it's still cold in the winter. I want to go somewhere where it's not cold.
So. Have a place to escape to when it's snowing outside here.
Exactly.
Just freezing cold.
Yep. Just pack a backpack and jump on a plane. You got all your stuff at your other house.
That's great.
Do you think playing it safe though? Like, if my real intentions were like, I don't want to pay this mortgage payment every month. I want renters to be able to pay this. It would make more sense to just buy as an investment property.
Yeah, I would think so.
I think so too. Like my whole thing though, because I was looking at it like single family house, because it has to be a single family house for the vacation loan. You can't get a multifamily. So then it's like, well, if I buy a multifamily down there and it's a 25% down, I can do all the investment stuff, keep one long-term tenant, and do the other one full-time Airbnb, and then go down there when I want. That would make the most sense. Like, that would be the better option to do. But it's just,
you're going to pay for that.
You're going to pay for it. Exactly.
Yeah.
So,
But you're right. I mean, that is probably the best of both worlds, because you'll always have a place to go to, because one of them's going to be short term.
mhm,
And so you'll always be able to find weeks where you be able to go down or whatever.
exactly.
But then when you're not there, you could rent it out too. The duplex thing in a vacation area, it would be kind of the dream.
Yep.
But like you guys said, yeah, it's going to cost you 25% down.
Yeah.
And I don't know how readily available those places are in vacation areas. I would think they're far and fewer between than.
So it's actually like, so Jersey, it's almost impossible to find anything
Oh,
under
I
like $1
figured.
million. That's a duplex or something. Unless you're looking at Atlantic City, because then you can get one for 60,000, which is like literally makes no sense to me.
You
like,
might get shot when you walk out at nighttime.
I
but-
know it's like I literally like went down like the map view on Zillow like over the whole coast of Jersey,
Jersey Shore.
and it's like anything under $500,000 like there isn't, and then it's like Atlantic City and you can buy a house for 30,000. It's like that's got to come up at some point. I don't know. It's
I would think so too. I'm
Yeah.
with you.
I think it's just because it was built on an Indian burial ground, or at least that's what Atlantic City feels like when you go in there.
I know. Yeah, it's as long as those casinos are there, I think it'll stay down for a while. But
I'm sorry. Go ahead.
no. I was just gonna say like we'll see, but
We'll see. I have a good feeling about Atlantic City. I think as the rest of the shore becomes more and more unaffordable for normal people,
Yeah.
people still want a place to go to. And I think Atlantic City's changing too. I think it's going to change more from the casino gambling area that we all know it to be into, they're going to use that commercial real estate to do resort type things for
Mhm.
people to come to. And I think the area, in my opinion, I don't know how long it's going to take. I just have a feeling that real estate is eventually going to go up.
oh, absolutely. I don't think you're
It
gonna
has nowhere else to go but up.
Exactly. And so you heard it here first, everyone. Buy in Atlantic
No,
City.
don't buy. We're buying.
Buy. No, yeah, that's but so that's what I was saying. In Jersey, it's like really hard to find multifamily.
Yeah.
And it gets the more south you go, Florida's full of multifamily.
Really?
Yeah.
That's interesting.
It
Okay.
is. I've been spending, over the last like 2 weeks, like a decent amount of time, just like every night, just kind of going through. I'm working with a realtor down there now, and like they're starting to set me up on searches and stuff like that. And I told him, I was like, okay, I either want a single family house that has the capability of short term rentals, a single family house with an ADU or a in-law suite, a duplex, triplex, like that. Set me up for all that, because like, and I just kind of explained to him what my goals were down there, and he's like, dude, it'll work. Like you can do that down here. And
Wow.
so we'll see. Well, we're like in center Florida is where I've been looking.
I was
like,
going to say, like, are there certain areas that you've been looking
Yeah.
at? Florida's a big state.
Yeah, it's
you kind of always
huge.
forget that. But
It's huge. So I've been looking
Yeah.
around like Daytona Beach, north and
Okay.
south of that.
yeah,
So it's more like in the middle there. Like you go down towards like West Palm and Miami and stuff. Like forget about it. And then the more north you go, it's
Just Georgia 2.0.
it's
pretty
just
much.
Georgia if you go north. So
all
yeah.
Orange Grove.
Yeah,
Yeah.
So no, it's I don't know. I'm super excited about it. I hate that I'm like this though, because I'm like I want to focus all in on like trying to make this 203K FHA, get this next property done, but I'm already on the one after that, and it's like I feel like I just gotta kind of relax, but we'll see.
Keeping your feelers out there. It's like I was saying when we started talking today, like having different revenue streams. It's the same thing like what you're doing. Keeping the opportunities open for one of those two things is going to happen. You're
Yeah.
either going to find the perfect place down there in Florida, and you'll be like, all right. And even if your other investment property around here doesn't work out this year because the right place doesn't come along, you'll have that came along, and you'll be able to do that. So as long as you're like constantly looking, I think it's a good thing.
Yeah.
You'll figure it out.
Gotta
I mean,
keep that pipeline open.
That's right.
Keep it full.
Yeah.
That's right. Yeah.
Exactly.
So
Exactly.
I guess going forward, we talked with Todd a lot about like credit score, like what we're really hoping to see, minimum 680. I mean, you can still get it up lower than 680, but kind of 680 is where you want to be when you start looking, and the more money you have saved, the better, no matter what. And we're all on board with that. But what would you recommend to like someone who they're in the process right now of saving and building their credit, like what would be the thing that you're like, you should really be focusing on this? Like, is it getting a better job, getting a better stream of income? Should it be just a higher savings rate? Should it be just more cash in the bank? Should it be a better credit score? Is it all the above? Is it, because that's the position that a lot of the guys listening to are in. It's this is the track that we want to go on, but like,
how do we get there?
How do we get there? What should we be doing now?
It's a great question. The unfortunate thing is you need like all three. And so I don't know that one's better or more important than another. What I kind of tell people is like, one out of the three can be awry. You can have a low credit score with a great job and a lot of money. We can probably do something. Or like vice versa. Like you can have a really high credit score, not a great debt to income ratio, so your income's lower, but you have a ton of cash. Probably do something with that too. So I guess just find somewhere in the middle, or find one thing to focus on, get that 100% where you need it to be or where you want it to be, and then move on to the second one. Or just try to man all three and do your best at where you can get to. Credit's a funny thing. It's a job to keep your credit score high. It's difficult. Like, it's not just about paying your stuff on time. Obviously, that's going to take you out of the running right there. Like a couple 30-day lates is going to really hurt you.
For a long time too.
For a long time. It doesn't go away. So making sure you're paying stuff on time, keeping your balances around like 30% utilization is the sweet spot. So that means if you have a credit card with $100 credit card limit, you should never have a balance of more than $30 on it.
So I've heard 10% for utilization.
10% might be even better when you're under 10%, but if you're above 30, I can guarantee you it's hurting you,
right.
Even if you have good credit.
Right.
You don't want to be that high. If you have good credit and you have more than 30% utilization, you're doing one of two things. You either need to up the limit on your card because you're clearly spending more than 30% of what the available balance is to you, or two, you need to work on paying those balances down and not keeping it. But yeah, I mean, 10% is even better. Like the lower the credit utilization is, the better. So I've heard of people saying like every 6 months, call their credit card company and tell them to bump their limit up. And like, yeah, it might sound crazy because eventually you're going to have like a $30,000 credit limit on your Citi card. But the more credit that you have available to you that you're not using, the better it looks in their algorithm for calculating what your credit score is. So you have to be responsible enough to not max that card out. But the more credit that you have available to you that you're not using, the better it looks.
I've had that happen to me, like specifically where I was buying expensive things just to resell, and my credit limit wasn't high enough, and I got dinged for it, and it sucks. So I've been calling my bank, regularly to try and bump that up. A question I was going to ask you was for younger people who just turned 18, should they get a credit card immediately and just start using it? Because from my experience, I think as soon as you turn 18, you should get 10 to 15 credit cards and then just use one of them and just keep all those cards. So that way,
so you have a longer lifetime.
You have a higher average credit age. And since you have 15 of them, when you get a new line of credit in 4 or 5 years from now, the average is only going to get dinged by, a 15th of what your average is.
I would say that's not a terrible idea if you're going to be responsible.
Right.
What I hate people or seeing people get into is you're not the same person at 18 as you're going to be at 25. No. You're not going to be as responsible. So if you're not the type of person who can handle having that much available credit to them, because you can do a lot of damage to yourself doing it that way too. If you pay one or two of those cards late, if you go over the balance, there's a lot of room for destruction. So you got to be careful. But yeah, getting a credit card early and using your credit is going to help you in the long run because your age of credit is going to be longer. You're going to have more of a history of using it responsibly. It's going to definitely help your score if you can use it responsibly.
I just wish someone had told me that, 6 years ago when I was, just turned 18 or was a little bit after, and just to get that set up because it helps you out with so many things in life. Your loans are so much cheaper with a higher credit score and everything, any type of loan, not just mortgages, but all your loans are cheaper. So yeah, if you're 18 right now, get 30 credit cards right now.
So, I did want to ask though, when I go to my bank and I ask for a credit increase, are they going to ding that as they don't ding it towards your credit score? Because I thought when you start like asking for increases, that normally shows that like you need cash. So it'd be like, I feel like it could go both ways there. What do you know if it does affect it?
I don't know that for sure. I can tell you that the credit cards, they might have done like some kind of a soft pull. I don't remember on like the credit monitoring systems that I have set up that alert me when somebody pulls my credit. I don't remember ever seeing that when they would increase limits on already existing cards that I had. I don't remember ever getting an inquiry. That's not to say that whoever your credit provider is wouldn't pull your credit, but I think if you have an established card with them, they're going to ask you like what your salary is, what your income is. Are we okay with taking the risk of increasing the limit? But I don't believe that they'd like ding you or repull your credit to increase a limit on an existing card. But I don't work in that type of banking industry.
Right.
I can only give you my experience from what I've seen. But I don't remember seeing that.
Yeah, that sounds right.
I don't remember getting dinged on mine when I did mine recently.
Yeah, I'm like kind of worried to like open the can of worms, like be like, hey, can you increase? And then they'll ask like what my income is, and I can tell them my W-2 income, which would support it, but it's like, do I add the rental income now? And now they're seeing that as more risk instead of more actual gain. I could see it going both ways, and I'm like, I just haven't asked, and they've just incrementally increased it on their own. Yeah. So
with banking, when you're dealing with anybody that's evaluating risk, it's the same thing. Like when I talk to an underwriter, less is more. So like I'd give them your W-2 income and then maybe ask them like, hey, do you repull my credit? Like how does this work? And then they'll tell you.
Right.
And then if they're like, oh, I'm sorry, we couldn't increase your limit to quite what you want, then you can bring open that door and be like, well, I actually own like some rental properties and I get some income from that. Would that help my case at all? But
yeah,
that's how I would go about it.
That's a good tip.
Yeah.
So yeah, unless you have, any other words of wisdom or anything that you think could be of value to the guys listening, we really appreciate you having you today.
Absolutely. I'm happy to be here. This was great. It's great chatting with you guys. Words of wisdom for the listeners out there is, you're already doing the step one is listening to something like this to gain some knowledge. That's invaluable. And then two, just when you have questions, reach out to a professional, see where you're at now, get it started and get on your way. There's no time like the present. Waiting isn't unless you have to, isn't gonna change your situation. So
yeah, no, that's awesome. Is there anywhere that people can find you, or like, they're looking to start the pre-approval process? How can they get in contact with you?
So I do have a website. I'm not going to lie to you. I'm not like super tech savvy. I don't have like some amazing website. I've been all my business is basically through word of mouth. Mm-hmm. But I do have a website. If you Google my name, Dylan Rauschenberger, it'll come up. Or if you wanted to Google, it's probably easier to spell Todd Hennessy. Him and I worked obviously together as a team. You'll be able to get in touch with us. There's an apply now button on our website. You can click that. Joanna from our team would reach out to you after you filled out your information to get you scheduled. And then we would do a webinar and review all your financing options and answer any questions you might have. And that's how you would get started.
Awesome, man. We'll definitely put that in like the description and stuff so people can spell your last name. It's a tough one.
Thank you.
But yeah, man, this has been awesome. And I didn't know we lived so close. We should grab pizza at Broad Street or something sometime. So
that'd be great. I've been meaning to check that place out.
That's
I mean,
nice.
I see the sign.
Yeah, it is nice. Cool. Yeah, so awesome, man. Thanks again.
Thanks a lot,
great.
Dylan.
All right.
Yeah, no problem, guys. Have a great night.
You too.